All right. Hey, good morning, everyone. Welcome to Thursday morning, the 22nd of August. We've got about 12 people here, and some of the regulars. Abraham, nice to see you. Lance, nice to see you. Dave, nice to see you. David is not here today, but we have a Nance. Nance, welcome to the show. Is that Nancy, or do you go by Nance? But welcome. First time. Nice to have you here today. For some of you, we're going to go over what we talked about a week ago. And I do need to apologize. Tuesday, I canceled. I said I was going to get a recording out. And in all honesty, I just got busy. And there was nothing that was so pressing that I thought, hey, we need to get into it. So for that reason, I did not do a Tuesday recording. When I start charging for these, I'll make sure I always have one out. But for right now, I didn't. So I do apologize for not having Tuesdays there. But last week, we went over a couple things when the market had its Wednesday dropped down 800 points. Monday was pretty ugly, 400 points, I believe, where I just wanted to point out to you that September is a 5-week options expiration, what makes it harder to wait. Patience, right, for credit spreads to expire. If you're going to put credit spreads on, you had to realize you're going to go through a waiting period before you got going. It would be foolish for me to assume that a market has a trend. What I meant by that, if you look at the S&P 500, especially here over the last little while, we had a big drop down, and then we're trying to find a footing. We now look like we're building a base. But in all honesty, we went through 3 days, where the S&P looked like it was going to hold the 50 and bounce higher. We broke through, and then we came back up to test, which we had one day where it finished higher than the 50-day. Bounce back down. You can almost say we have a triple bottom here. And here we are back up testing the 50-day simple moving average. I'll be honest with you, I am a little surprised. I would think that with how well retail has been coming through, I would have thought that possibly retail would push us higher and through a 50-day simple moving average on the S&P 500. It has not happened. But if we take a look at some of the other main indexes, right? The Dow Jones isn't really an important one. It's only 30. This is one that's more used because of tradition. If you take a look at the Dow, it had a hard bounce off of the 200-day. And I'll be 100% honest with you, it looks like it just looks like it doesn't have the same momentum as the S&P 500. If you went and you took a peek at the Williams percent R, it sits right where the S&P 500 does as well. It also looks like we're going to get our crossover on the MACD, but it does not look as strong. And then out of curiosity, where would you think the NASDAQ would be at? I go through the NASDAQ composite. That seems to be more of what institutional traders look at. And it really has been fighting the 200-day, or excuse me, the 50-day simple moving average. And it has bounced more off of a horizontal level of support, not the 200. So we have 1, 2, 3, 4, 5, 6, 7, 8 days. It's testing the the 50-day simple moving average. Now, a little interesting by my opinion, as I take a peek and I look at the NASDAQ, or all of them, they all look a lot the same to me. I truly don't see a building of a base. There is too much up and down and across and a small gap and a gap down. I do not see a building of a base. I see more of this type of movement than building a base like we are right here. So I'm a little uncertain. You can justify that we look a lot like this right here, and maybe we are starting the building of a base to break above it. Again, that would most likely have to come from retail. Retail stocks are doing significantly better than expected. When you hear that, it makes you wonder if you feel that that retail can pull our market over a 50-day simple moving average. It would be surprising for me. I would probably tell you it probably has to be financials. And we don't look like the building of the base there, so pretty interesting. The XLF. The XLF would be the example of financials that I would expect to move us out of a resistance level at the 50-day simple moving average. And I'm sorry, I look at the financials right here, the XLF on the S&P 500, and I don't see it. I don't see it, which worries me. To be 100% honest with you, it obviously worries me. So coming back to what I was trying to point out a week ago, some non-directional trades are the higher probabilities of being profitable. Long condors, protective puts, collar trades, strangle straddles. Right now, I feel you need an extreme patience in managing the trades. You have to use some common sense. You don't just put bullish trades on them in the morning on bearish moving stocks or bearish moving market. Low tides sink all ships. So you need to have some common sense when you're placing a trade. If I go through a trade last night and we look at our market today, you could have some type of discretion that would be needed to say, you know what, probably not the best of times to be placing a trade. Hey, what Kevin might have seen yesterday doesn't look the same today. And all that is volatility. I made the comment last week, use common sense, that saving nickel or dime or a quarter doesn't matter if you could have saved dollars by not placing your trade. Use limit orders if the trend changes, but don't think it protects you. It doesn't necessarily help you. It might not be important the next day. I would definitely be using some limit orders to exit a trade if my trade became profitable during the day. And obviously one of the hardest things to do when you trade is patience. Patience to not force a trade, patience to look for an opportunity that might present itself in an unbelievable, how am I trying to say this? In a way that might present itself in an unbelievable opportunity. So where I'm going to go at with this, opportunities are far and few and in between right now. Abraham make the comment, non-directional but long-term considering the uncertainty. Yes and no. In all honesty, if you if you want to do non-directional, where you want to make something on the downside through September and October, and then see it rebound into a Christmas rally at the end of the year, a China deal, most definitely non-directional long-term. With that said, the long condors or the protective put strategies have been really good for some short-term trades if you're willing to get out really quickly, and 2 to 3 weeks playing some earnings. If I had more profit in Baidu, I could have got out of Baidu closer to 114 and played it as a trade for a short-term protective put strategy. So again, it's always one of those woulda, coulda, shouldas. I could have done that. And, you know, I guess the short answer is really comes down to take a profit as often or as quickly as you can. That's what I might suggest to you. So what I was looking at for today is a stock that seems to be bucking the trend. A stock that has its earnings coming up that you could do a pre-earnings run possibly on American Outdoor Brands Corp. So if you were to look at this chart, I'm going to go ahead and I'm going to put it on here. If you were to look at this chart, come on, catch up. This PC. If you were to look at this chart as soon as I get it to come up for me and I stick it in here, I'm going to ask you a couple things on what do you see in the chart. Here you go. Here's your chart. AOBC. What do you see as you look at this chart? Give me a couple comments on it. It's bearish. Good observation. Definitely bearish with earnings on 08/29, I believe. Let's just make a quick check to make sure I'm not wrong there. 08/29 after the market closes. What else can you tell me about it? It looks like it's bottoming for the short term. Boy, I really like that answer. I would agree with that one. Looks like it may be bottoming. Now, unfortunately, it's not bottoming at the most recent lows. It missed the 850 range. It missed it. Plain and simple, it missed it. So we need to go back out to our chart and we need to pull it out a little bit farther to find out if we have some reference point on where and why this stock is bottoming. So that's really that's the real question. Do we have a reference point that we can see that justifies where this stock is bottoming? And we don't. It's not there. It's not there at all. It has no volume, so thinly traded. That is a very interesting observation, because to a certain degree, you are 100% right, Ida. This one right now is only trading at 245. Volume on the 10-day average is 632,000. It does not comply with the fundamental analysis of being a million shares or more. So if fundamentally you did your research on this company, it would not pass your volume test. It just wouldn't. Looking at AOBC, long-term downtrend, but what do you notice about the downtrend? And all of a sudden, we're going to support Abraham's comment. It looks like it's bottoming, and it's doing so off of a long-term bottom trend line. So looking at this chart on American Outdoor Brands Corp, what's the upside potential? What's the upside potential on AOBC? Somewhere at that $9.25 range to $9 to possibly $8.75. It's going to fight the 200-day simple moving average. We have a stock here that's going to be a little bit capped, would be one of the best ways to say it. It looks like there's going to be a capped opportunity here. So Kevin, what the heck are you doing? My crystal ball says 1045. That's funny. And Nancy, or Nance, you didn't get back to my question there, I don't believe. Bottoming. Oversold, right? Oversold on the RSI. Oversold on the Williams percent R, where institutions are not getting into it right now. So this is what I'm going to tell you. I'm going to take a flyer. For me, it would be an adjustment to a previous trade. For some of you, it could be a new position to be in. But I would take a flyer on this stock. Kevin, define what a flyer is. I want to give it time, like Abraham said, to get through an earnings event, to get through a Christmas rally or a Christmas season. So I would go out to a December or a January 2020. Some of us already have positions in play. Positions that have been dollar cost averaged, positions that have actually, on my long side, have been rolled down. So here is my new trade if I was going to put one on today. It's a flyer. It's one to try to make some good money, only going out to true, only going out to what am I trying to tell you guys? I got a little confused there. I saw Abraham's comment. I would go out and I would look at some options, and I would be going out to the January 20. I would be looking at an at the money $9, and I would be selling an at the money $11. Why do I like this trade? I like the idea of being able to double my money just going up to a resistance level at little over $9. It's an out of the money bull call. It's cheap. In all honesty, it is ridiculously cheap. As I take a look at it, it's cheap. Can I say it again? It's cheap. It's a $400 trade that can double its money at earnings, moving up to resistance. It's a short-term one that I could get out of relatively quickly with a pre-earnings run into next week. I like next week because I honestly think big money will most likely be out of the market as we go through our Labor Day holiday weekend, where the following Monday is a day off. So as I look at it, to me, it looks cheap. If I look at my snapshot analysis, risk to reward, you get 4 rewards for 1 risk. Now, I don't like the maximum profitability or maximum loss, but the neat thing is, because I've put it at $9, and because on our chart we have a reference point, we could move our shorts down to 8 in an adjustment strategy. We already have the reference point where we could move it down to an 8 to possibly make up most, if not all, of that 40 cents it would be trying to make up. So in all honesty, I really like the bottoming that it appears to have right now as a reference point for an adjustment. It, for me, as I take a peek at it, being a flyer, I like my opportunities. I like where my break even where it could sit at. Most importantly, I really like, come on. I was gonna say I really like the delta. Give me a quick second here. Where Where's my delta at? I really like the delta of 25 cents. Long 3.9, short 1.6. It was 25 cents. It's now 23 cents, which tells me on 40 cents of risk on a dollar movement, I'm looking at a 50% return. I like it. There's not much that talks me out of being in this trade. Now, it's a flyer. Means possible 400% return on investment, which means need to be ready for an adjustment, which means riskier than normal, i.e., probabilities are not in your favor. But the question is, right, is it worth the risk? And that's where you guys get to make that decision. For me, I like it. A couple comments I've missed here. Isn't it more prudent to do a 6-9 spread, even if it's more expensive to get in? So, Abraham, that's an interesting question, because what you just said is a risk tolerance question. Kevin, isn't it more prudent to do a 6-9? So, would I want to take 4 times the risk for 1-to-1 reward, risk to reward? For me, no, it's not. It's not more prudent. I wouldn't want $1.57 to make a buck, 43. We all know 9 is where it's going to most likely stall out at, right? Or even 8.75. So risk to reward says no to me. It's one that I would not be, in my opinion, it would not be more prudent for me to be doing this one. If we changed it, let's check out that 7.5 and 10. – 7.5 to 10 makes a little more sense. So the short answer is I think I'm good where it's at. I would keep it right where it's at. But good questions. All right, guys. Hey, I will get this posted here shortly. I appreciate all you guys coming. Nance, nice to have you here. Welcome to joining for the first time or being with us for the first time. I got some of my regulars in there as always. Glad to have you with me. Guys, have a wonderful day. I'll get this posted relatively quickly here. And again, welcome. Appreciate your questions. Always welcome to have you here. Enjoy your weekend. And until Monday, take care, everyone.